Hello, everyone. I'm Cole Altom, a managing editor here at Stratfor. With me today is Mark Fleming-Williams, our economy analyst. And today we're going to talk about our monthly Compass preview. This month, our attention turns to Russia. So, Mark, thanks to the Ukraine crisis and the sanctions that were imposed because of it, Russia is finding itself more isolated from the West, not just politically, but economically and financially as well. And unsurprisingly, in recent financial news, Moscow has announced that it would create a new credit rating industry. For those of us who don't know what that is, tell us what they are and why they're important.
Well, first of all, they're developing their credit rating industry. They already have Rus Rating, which is a very domestic credit rating agency. Why it's important is for two reasons. First of all, the credit rating industry essentially sets the tone for the investment management industry in terms of deciding whether or not they're going to buy bonds and shares. The credit rating industry essentially decides whether or not a company is solvent and how likely it is to default. And so as a result, if a credit rating agency downgrades a stock, then the cost of obtaining debt for that company goes higher. And the other reason why it's important, particularly for Russia, is that at the moment, 96% of credit ratings are done by 3 American agencies.
So why is Russia talking about developing this industry right now?
Well, it's been a rough year for Russia. They've seen geopolitical tensions growing in Ukraine, and as a result, a lot of investors have decided to take their money out of Russia. Alongside this, we've seen sovereign credit rating downgrades from Standard & Poor's and Moody's, as well as a lot of corporate credit rating downgrades as well. What this means is that Russian companies and the Russian government is having to pay much more for their debt. Now, for the Russian government, that's not a huge deal. Their debt to GDP ratio is only 13%, which is minimal compared to their peers. Where it does become a problem is when you start looking at the corporate and bank bonds, because here we have $500 billion worth of debt, which is held largely by Western investors.
Well, it sounds as though it's a matter of funding. So where can Russia find more funding if not the West?
Well, they have found other sources of funding. In the last 5 years particularly, then Russia has been turning more to China for funding. We've seen China getting more involved in investing in development projects across Russia. The trouble for the Russians is that the Chinese money is public rather than private. Mm-hmm. So rather than being held in the hands of investors who want to make the best return for their clients, we have it being held in the hands of a large neighboring, potentially threatening nation, which is looking to make strategic investments. So we've seen China's sovereign wealth fund investing in things like oil projects and potash companies, which is quite a strategic mineral. So from the Russian perspective, they have access to money at the moment, but it's got strings attached, which could be quite dangerous.
You say most of the wealth is publicly held in China, but China's economy is maturing, and so too is the growth of private wealth in the country as well, correct?
Yes, absolutely. So there is a growth of private wealth. At the moment, it's about development of that wealth. So at the moment, the vast majority of private wealth is just held basically on deposit in banks, commercial banks. So 70% of the market is just held on deposit. So as a result, you have money which isn't being really used for adventurous purposes. The good news for Russia is that this looks set to change in the coming years. The Chinese fund management industry is projected to grow 6 times in the next 5 years. So we've got a huge growing amount of capital which could be devoted to things like Russian bonds, which at the moment, because all the Western investors have moved out of them, they look very cheap. The other aspect to this to bear in mind is also the capital controls aspect. Another reason why Chinese capital has been unable to cross borders so easily is the Chinese grip, which is held on stopping that from happening. But at the same time, China at the moment is trying to make its currency more international. It's trying to turn the renminbi into a kind of second reserve currency, perhaps. So in order to do that, it's going to have to loosen up its capital controls. So the next few years are likely to see a couple of changes where the wind is blowing in Russia's direction.
So Mark, give us a forecast. What does this mean for the credit rating industry?
We would expect the credit rating agency industry to reflect what is happening in terms of the fund management industry. So at the moment, we have a Western-dominated fund management industry, and so as a result, 96% of credit ratings are done by Western credit rating agencies. As this changes and we begin to see more fund management money arriving in places like China, we would expect to see more clout being lent to agencies in China and Russia as they grow in influence and crop up more.
Mark, thanks very much for your insight today, and thank you for joining us. Compass publishes May 4th.